Let's get across the market open now. Joshua Barker joining us from RiverX. Josh, good to see you on this Friday. Global equities a little lower overnight. Look, the Middle East remaining a huge concern. That's adding to that uncertainty, isn't it?
Yeah, we're in a really interesting spot where things were looking really quite good before this. We had the Fed cut, inflation really had a handle on it, and economic growth still looking okay. Even last night's sort of labour numbers, not reading too much into them. They were slightly worse than expected, but in the grand scheme of things, still relatively quite low and not a concerning number at all. So we're sort of seeing a little bit of that geopolitical tensions start to weigh on the markets, and if we look past, it hasn't really had too much of an impact on the markets long term. It's actually kicked off in that area about a year ago, and obviously we've had the Ukraine thing, but what that's really taught us is that when those sort of political events can put pressure on like an underlying issue, such as inflation, for example, or energy prices, as we saw over the last few years, that can really have a flow-on impact to the economy and inflation. And then, potentially if inflation picks up again from this increase in energy costs, oil spiking, also you've got the shipping costs as well, so that could have a real flow-on effect. And this is when the Fed thought that, okay, inflation was sorted. We could see them, very unlikely, but we could see them have to react to that. Probably don't think that's going to occur, but the market could look at that being a possibility, which could lead to a lot of heightened volatility anyway.
Well, you mentioned shipping costs. On top of that, of course, the risk to inflation is the port strike in the US as well.
Exactly. So it's sort of, when you've got these underlying issues that are made worse by current circumstances, it has a real impact on the economy, more than just the sort of tensions themselves.
Now, of course, markets have been fueled by that stimulus we saw out of China last week, in particular resources, of course. How are you looking at that now, given how hard it's run?
Yeah, look, it was an incredible run. Probably 3 week, quite dramatic rise in the Chinese markets. But if you sort of zoom out, it was really just making up for the last few months leading up to that, and a pretty severe underperformance. So we've sort of started to see that fleet out now. Chinese markets down last session. So that combined with the sort of overall political landscape. Obviously, you've got the political voting risks when Trump potentially coming in, and that impact on tensions with China. So yeah, there's a lot of uncertainty, and I think that that band-aid solution that they put over the top, sure, it's great, band-aids work, but if there's a broken bone underneath it, it's not really going to help.
So what's your response then? What are you doing portfolio-wise, just in terms of, given what we've seen, particularly in resources, and I guess more broadly, your exposure to those Chinese stocks as well as here locally? Yeah,
resources is such a broad category. There's sort of Chinese resources that we're so dependent on, such as iron ore, for example. But then there's the more global landscape, things like copper, which is continuing to do pretty well in the grand scheme of things. So, sort of preferring the sectors such as, even your energy plays. So things like uranium, I think that's sort of impervious. That's sort of in the global category where there's a global bid tone. But then you've sort of got iron ore and lithium in that really China exposed. So looking to keep on the sort of things that were favourable towards on a global basis and reduce those ones that are really impacted and are highly correlated with China anyway.
So any stocks in particular looking to lighten at least at the moment? Yeah,
well, a lot of Aussie investors have things like Fortescue and BHP in the portfolio, often at the same time. We'd definitely be a lot more favourable towards BHP given that copper exposure in it, and obviously Fortescue being a pure play, they're going to be the most subject to that Chinese risk, and they've sort of gotten away with a lot of their core functionality and really dependent on that iron ore exposure only, not moving into any other areas at the moment, and not for the foreseeable future anyway. It's had a great run over the last 5 years from both capital growth and dividends. That sort of percentage there is obviously great, but it doesn't include all the dividends and franking credits you've accumulated. So I think it was a great place to be over the last 5 years, but its underperformance over the next 1 to 2 years is probably going to hurt your portfolios. So I'd look to lighten or sell your Fortescue, and then
Is that based on where you see the iron ore price going at the moment?
Yes, exactly, and sort of that Chinese stimulus fizzling out and the long-term trend resuming for them.
Yep. All right. Elsewhere, Wesfarmers.
Yeah, look, there's been a lot of sort of, I guess, blue chip companies that have experienced really phenomenal rallies, and we experienced this a lot over the last couple of weeks, where a lot of money flooded into those big resource names like a Fortescue, like a BHP, and that's probably a lot of international money coming in, and a lot of local money sticking with the safety of larger names, as we were. We've sort of been battling the possibility of a recession over the last couple of years. So your larger names are going to be a lot more, sort of stable throughout those sort of periods. So things like Wesfarmers has put on great performance from a share price point of view, but its fundamentals are growing at a pretty slow rate. Revenues was up by like 1 or 2% the last two reports. Earnings are up 3 to 4% over the last few reports. And because of the share price rally, now the dividend yield is down at about 2.8%. So pretty low yield, and it's trading on a PE of around 30. So I don't think it's necessarily done too much that's really exceptional. Obviously, they've sort of been working on, it's been a while now, but they've been working on some of that lithium exposure. That's not going to be as profitable as what people thought it was when they were sort of first talking about that. So there's a few underlying risks to the business there as well.
And in the REITs space, what are you looking at the moment?
Yeah, again, another really good example of a lot of money that's flooded into the market in Goodman Group with the bet on data centres, which is 100% justified. However, you're in a situation where the stock's done extremely well in any sort of time period. 78% on a REIT in 1 year is phenomenal. And now what you're going to be faced with is, understanding what's inside the business, it's a property portfolio. So is that property portfolio going to be outpacing the share price that we see that's being priced in at the moment? And it's very unlikely for that portfolio to sort of match a 78% return. So there's going to be some sort of recalibration there, or at least a slowing in share price that's going to underperform the market. So we've been definitely happy to lighten and take the win in things like Goodman Group, and it's grown to be such a huge market cap. It's almost 100 billion market cap. It's at 72, but it's sort of, if it keeps growing at this rate, it'll be there, and I don't think that's necessarily too justified given its portfolio size anyway. So
just to wrap up, so regionally you're looking to fade perhaps the ASX in China, and you're looking at India. Why is that? I mean, that's run really hard. It's
run really hard, but it does have a very low correlation with the US market, and particularly in the Aussie market by extension. And with that, you sort of got a lot of risks on the table. You've got a lot of Aussie risks related to China. You've got Aussie lit risks related to the US, and obviously the tensions that if they get started into war, plus their sort of election coming up. A lot of risks out there, and none of those risks overly impact the Indian market. They're very consumer-driven market, which is the opposite to China, as we've seen from the stimulus. It doesn't really matter too much about the consumer in China. It's about what the government does, whereas India is the polar opposite of that. It's really about that consumer spending, population growth, and no matter what sort of political changes or even sort of economic changes happen, they've still got that really strong fundamental growth with the population spending that they're experiencing over there. So it's an area to park your money where it's just going to have a different uncorrelated performance to a lot of what you already have, which is probably the Aussie market and the US market and things dependent on that.